This presentation is going to be about degree of operating leverage and its usefulness in predicting net income, which will be presented by Torres, Alfaro, Grieb, Allison, Swanson. Degree of operating leverage. The degree of operating leverage, DOL, is the leverage ratio that sums up the effects of an amount of operating leverage on the company's earnings before interest and taxes, EBIT. Operating leverage takes into account the proportion of fixed costs to variable costs in the operations of a business. If the degree of operating leverage is high, it means that the earnings before interest and taxes would be unpredictable for the company, even if all the other factors remain the same. Degree of operating leverage formula. DOL equals percentage change in EBIT divided by percentage change in sales. Equivalently to degree of operating leverage, DOL equals contribution margin divided by net operating income. What you need to know. Various measures can be used to interpret operating leverage. These include the ratio of fixed costs to total costs, the ratio of fixed costs to variable costs, and the degree of operating leverage, DOL. All these measures depend on sales. The ratio of fixed costs to total costs and fixed costs to variable costs tell us that if the unit variable cost is constant, then all sales increase. Operating leverage decreases. The DOL tells us as a percentage that for a given level of sales and profit, a company with higher fixed cost has a higher contribution margin. The marginal profit per unit sold, therefore, its operating income increases more rapidly with sales than a company with lower fixed costs and correspondingly lower contribution margin.
A crucial assumption when doing CVP analysis and determining a firm's degree of operating leverage is that prices stay the same as output changes. This means we're looking at a firm in a perfectly competitive market, or, for example, a farm. Let's look at how an example would play out.
In this example of the Fresno State Farm shows different scenarios that will impact degree of operating leverage. In this example, to get the degree of operating leverage, you divide contribution margin, which in example 1 is $50,000, by the net operating income, which is $40,000, which comes out to a degree of operating leverage of 1.25. As shown in this example, as we approach the break-even point, the degree of operating leverage approaches infinity, which is shown in the last column, which is example 3 for the Fresno State Farm. Degree of operating leverage shows at the Fresno State Farm how risky their operating income is.
Although the degree of operating leverage is calculated by taking the contribution margin and dividing it by net operating income, it actually tells us something that may not immediately be noticeable through the formula. The DOL, the degree of operating leverage, is also a numerical measure of the percentage change in net operating income given a 1% change in sales. Just like a fraction, it's easy as that. So, to answer the question found in our text on page 208 of explaining how it can be used to predict changes in net operating income, this is how. If we know the degree of operating leverage and by how much our sales have changed, we can then use this formula to find out how much our net operating income will change. This is crucial for business.
After explaining to you in detail of what degree of operating leverage is and how it is correlated to net income, let me take a few seconds to recognize our sources that allowed us to inform the viewers about this accounting concept. Our Accounting 4B book, Intro to Managerial Accounting, and the websites Investopedia, Accounting Tools, and Rady Ratios. Thank you. I hope you enjoyed this video.